Everyone is probably asking the same question right now. When exactly is the crash coming? Oil prices are rising again and could potentially hit USD $200 per barrel. And historically, that has often been the first domino before recessions and market crashes. So let's take a look at history. During the 1973 oil crisis, we can see that oil prices quadrupled and the global economy soon fell into recession. And during the 1979 oil crisis, oil doubled again, triggering inflation and another downturn. And even so, during the 1990s oil price shock, oil surged sharply before the US went into recession. So historically, we can see that oil spikes tend to appear before economic stress. But here's the key insight that most investors miss. The market usually doesn't just crash like this immediately. Historically, there is often a 6 to 12 months lag between an oil shock and the real economic damage. That's because higher energy prices will slowly creep and ripple through the economy. Transport costs rises, food prices increases, business will start to face higher expenses, and eventually, consumers will start cutting spending. So this is when markets start to react. There is also another level that many economists watches. So when oil moves towards 120, 130 or even 150 per barrel, recession risk historically rises sharply. So at those levels, energy cost becomes a major tax on the global economy. So if tensions involving Iran escalate and disrupts the supply through the Strait of Hormuz, where about 20% of global oil flows, prices could definitely spike really quickly. So I'm not going to sugarcoat it. It could get worse as I am speaking right now. Iran's Islamic Revolutionary Guard Corps has declared that it would not allow even 1 liter of oil, 1 drop of oil through the strait. So if you're wondering whether the crash is starting, professionals usually watch out for these 3 signals, and you should too. Firstly, the CBOE Volatility Index, also known as the VIX. In real crisis, VIX spikes above 40 to 60, but right now it's under 30. The level is still considered moderate. And secondly, credit spreads. Professionals track the gap between the corporate and the government bonds. When this gap widens sharply, it signals financial stress and recession risk. So far, spreads have widened slightly, but not at panic levels. And thirdly, technical analysts watch indices like the S&P 500. Real crashes often follow a sequence. Firstly, price breaks the 200-day moving average, the rebound fails, and lower highs begin forming. So right now, the long-term trend is weakening as we see it, but not fully broken yet. So if you're asking me, that financial goal, when is the crash coming? I would say history suggests this. Oil spikes are often the first domino, but the real danger comes later. When high oil prices persist, fear spreads, credit markets crack, technical trends break, and financial conditions tighten. So for now, I think those final signs haven't appeared yet. So how about you guys? Do you think the market is crashing? If you enjoy my content, do follow me, and this is That Financial Goal. Do remember to hit the like, share, and subscribe button, and I'll see you guys in the next.